welcome to the Property Wealth Podcast. We're so glad you're joining us today. If you've been thinking about how to build passive income through rentals, you're in the right place.
Absolutely, Sarah. You know, the idea of generating income while you sleep is really appealing, right?
Yes, it's like having your money work hard for you. So in this episode, we're going to dive into some practical strategies to get started with rental properties and share some tips that can help you along the way.
We'll cover everything from finding the right property to understanding cash flow and the importance of location, and even some common pitfalls to watch out for.
Sounds like a lot of ground to cover. And I think it's really important for our listeners, especially those over 40, to know that it's never too late to start investing in real estate.
Exactly. It's all about taking that first step, you know?
Right. And we want to make this journey relatable and accessible for everyone tuning in. So let's jump right in and start exploring how you can turn that dream of passive income into a reality.
Let's do it. You know, Sarah, when we talk about building passive income through rentals, it really hits home for those of us over 40 because, well, retirement isn't that far off, right?
Absolutely, Mike. It feels like the clock is ticking sometimes. And with the way things are going economically, it's more important than ever to secure that financial future.
Exactly. I mean, look at inflation. It's been all over the news. Prices for everyday things have skyrocketed. If you're just relying on savings or a fixed income in retirement, that could be really tough.
Right? It's like your money just doesn't stretch as far as it used to. I was talking to a friend the other day, and she mentioned that her grocery bill has nearly doubled in the last few years.
Yeah, and that's a perfect example of why creating passive income is so crucial. It's about having that extra cushion. Real estate can be a hedge against inflation because, you know, property values usually go up over time, right?
Definitely. It's like a buffer that helps protect your wealth. And if you own rental properties, you can adjust the rent to keep up with inflation, which isn't something you can do if you're just sitting on cash in a savings account.
Exactly. I had a client, let's call him Tom. He's in his mid-50s and was really worried about retirement. He owned a few rental properties, and while he initially thought he'd just sell them off for a lump sum when he retired, he realized those properties were generating a steady income each month.
That's such a smart shift in thinking. So instead of a one-time payout, he has this ongoing stream of income that can support him in retirement.
Right. And it made him feel more secure about his financial future, which I think is a huge emotional aspect of investing in real estate. It's not just about numbers, you know. It's about peace of mind.
Absolutely. And let's not forget about the potential for wealth transfer to family. So many of us want to leave something behind for our kids or grandkids.
For sure. I had another client, let's call her Linda. She bought a duplex a few years back. Her plan was to live in one unit and rent out the other. Now, she's not only building her own wealth, but also creating an asset that her kids can inherit one day.
That's such a thoughtful approach. It's like she's setting them up for success, too.
Exactly. And, you know, when you think about the current market trends, there's a lot of talk about a potential recession.
Yeah, it's definitely on people's minds.
Well, in times like these, having real estate can be a stabilizing factor. While stock markets can be volatile, property tends to hold its value over the long term.
I mean, it's not immune to downturns, but it often rebounds stronger.
Right. Plus, there's that added bonus of leveraging the property. You can use the equity you build up to invest in more properties, creating a snowball effect.
That's such a powerful strategy, and if you think about it, people over 40 often have more equity in their homes than they realize.
Exactly. I've seen people use that equity to finance investment properties, which can be a game changer.
And speaking of game changers, what about the emotional side of financial security? I know it brings a sense of freedom and flexibility.
Oh, for sure. I mean, think of it this way. If you have a steady stream of rental income, it can take a lot of pressure off of working a job just to pay the bills.
Yeah, it's like having a safety net. You can take more risks or even consider early retirement.
I once worked with a couple. Let's call them Dave and Carol. They were both in their late 40s, and they had been living paycheck to paycheck. Once they started investing in rental properties, it was like a light bulb went off for them.
What happened?
Well, they started out with just one small property. When they saw the income coming in, it completely changed their mindset. They realized they could actually build wealth and not just survive.
That's so inspiring. It's like they found a way to thrive instead of just getting by.
Exactly. And as they built their portfolio, they began to feel more in control of their future, which is such a huge emotional benefit.
It's incredible how much our mindset can shift when we take proactive steps toward financial security.
It really is. And it's about making informed decisions. I think a lot of people feel overwhelmed when they think about real estate investing, especially if they're just starting out.
That's true. But the beauty of it is you don't have to dive in head first. You can start small and grow from there.
Absolutely. And that's where we can help by sharing practical strategies, tips, and real-life examples to make the journey feel more achievable.
Yeah, I'm excited to dive into those strategies next. It'll be great to give our listeners some actionable steps they can take right away.
Let's do it. So when it comes to building that passive income through rentals, one of the first things I always recommend is understanding the 1% rule. It's a quick way to gauge whether a property could be a good investment.
Right, the 1% rule. That's where you look at the monthly rent, and it should ideally be at least 1% of the purchase price, right?
Exactly. So if you buy a property for, let's say, $200,000, you'd want to aim for at least $2,000 a month in rent. Now, it's not a hard and fast rule, but it's a great starting point.
That makes sense. It gives you that quick snapshot of the potential cash flow. What about the 50% rule? I've heard about that one too.
The 50% rule is another useful guideline. It suggests that you should estimate your operating expenses to be about 50% of your gross rental income. So if you're pulling in that $2,000 a month, you'd set aside about $1,000 for expenses. Things like maintenance, property management, and taxes.
So if you're following those rules and your income minus expenses still leaves you with a profit, it sounds promising.
Right, and then you can dive deeper. You might want to calculate the cap rate. That's another important metric. It's the net operating income divided by the purchase price, expressed as a percentage.
Okay, so if we keep our $200,000 property example, let's say you're getting that $2,000 monthly rent.
Right, that will give you $24,000 a year in rent. And if your expenses are $12,000, your net operating income would be $12,000. So your cap rate would be $12,000 divided by $200,000. That's a 6% cap rate.
That's pretty solid. So higher cap rates generally indicate better returns?
Exactly. But you also want to consider the market. A high cap rate in a declining area might mean more risk, whereas a lower cap rate in a stable, growing area might be safer.
Got it. So how do you evaluate a deal more thoroughly? Are there checklists you recommend?
Absolutely. I usually start with a checklist that includes the property's location, condition, and potential for appreciation. Also, check the neighborhood's rental market. How much are similar properties renting for?
So you'd want to look at comparable rentals to ensure you're not overestimating what you can charge?
Exactly. And don't forget to check the vacancy rates in the area. High vacancy could mean you'll have trouble finding tenants.
Right, and that impacts your cash flow. What about financing options?
Financing can be a game changer. Traditional mortgages are common, but you might want to consider options like FHA loans if you're a first-time investor. They allow for lower down payments.
That's helpful, and I imagine private money lenders or even partnerships can also be an option.
Definitely. If you find someone who's interested in investing, it can help you leverage more opportunities. Just make sure to have clear agreements in place.
Yeah, you wouldn't want any misunderstandings down the line. What about different property types?
Good question. Single-family homes are popular for beginners, but multifamily properties can offer higher cash flow since you have multiple rental units.
Right, and I suppose with multifamily, you also spread the risk across several tenants.
Exactly. If one unit is vacant, you still have income coming in from the others.
And what about short-term rentals? They're all the rage these days.
Short-term rentals can be lucrative, especially in tourist areas, but they come with their own set of challenges, like managing bookings and cleaning between stays.
So you really need to weigh the pros and cons depending on your goals, right?
Absolutely. And one thing I always tell new investors is to build a solid reserve fund. Unexpected repairs or vacancies can hit hard if you're not prepared.
That's a great point. Having a cushion can save you from a lot of stress.
Right. And speaking of stress, a common pitfall is underestimating the costs involved. People often think they can just calculate the mortgage and rent and call it a day. But there are so many hidden costs.
Like what?
Well, property management fees, maintenance costs, insurance, and even legal fees can add up quickly. You have to factor those in to get a true picture of your cash flow.
So it's key to budget properly and not just go off the initial numbers.
Exactly. And another pitfall is getting emotionally attached to a property. Investors can sometimes overlook red flags because they're enamored with the idea of owning it.
I can see how that would happen. It's important to stay objective, right?
Yes, always make decisions based on the numbers and your investment strategy.
Great advice. And, one last thing on evaluating properties. What about the importance of conducting inspections?
Oh, that's crucial. Always get a thorough inspection done before closing. It can save you from costly surprises down the road.
For sure. It's better to invest a little up front rather than face big repairs later.
Exactly. And that brings us to the next crucial aspect of this journey, which is navigating those common pitfalls that can derail your plans. So, one of the big pitfalls that I see with new investors is over-leveraging.
Right, that's a huge one. It sounds tempting to borrow as much as you can for a property, but...
Exactly. I once knew someone who purchased a couple of properties using nearly all their savings as a down payment, plus maxing out their mortgage. It worked for a while, but then...
What happened?
Well, unexpected expenses hit, repairs were needed, and suddenly they were stretched too thin. They couldn't afford the mortgage payments when their cash flow dipped.
That's so stressful. I can't imagine the pressure they felt.
Yeah, it was tough. They ended up having to sell one of the properties at a loss just to stay afloat. It's a classic case of not having enough buffer.
Right, and it's not just about the monthly payments, but also, having that emergency fund, right?
Absolutely. Always have a financial cushion. It's like the old saying, don't put all your eggs in one basket. Diversifying your investments can really help mitigate that risk.
And speaking of risks, bad tenants can really throw a wrench in things.
Oh, for sure. I remember a friend of mine rented to a couple who seemed perfect on paper. Good jobs, great references. But once they moved in, it was a different story.
What happened?
They stopped paying rent after just a couple of months. Turns out, they had financial issues they hadn't disclosed. It took months to evict them, and during that time, he was left covering the mortgage out of pocket.
That's such a nightmare.
It really is. The key is to do thorough background checks and trust your gut. If something feels off, it probably is.
Definitely. And it's not just about the rent, but also the kind of tenants you want living in your properties.
Exactly. A tenant who respects the property and pays on time can make all the difference. It's worth taking the time to find the right fit.
And then there's cash flow. Some investors seem to ignore this completely.
Yeah, cash flow is king. I once worked with a client who bought a property that looked like a good deal on paper, but when we ran the numbers, it barely broke even.
That's rough.
Right? They were so focused on the potential appreciation that they overlooked the monthly expenses. When the market corrected, they found themselves in a tight spot.
So how do people improve their cash flow situation?
Well, first, do your due diligence. Understand all your expenses, not just the mortgage. Factor in property management, maintenance, taxes, and utilities.
And sometimes there are hidden costs that people forget about too, right?
Yes. I had another client who didn't account for the costs of repairs and maintenance. They bought a fixer-upper, thinking they'd save money.
That can be a trap.
It really can. They underestimated how much work it would need and ended up spending twice what they budgeted for renovations.
Wow. So budgeting for those fixes is crucial.
Definitely. And make sure you have a reliable contractor you can trust. If you don't, you could be in for a nasty surprise.
And then there's the whole idea of timing the market.
Ah, timing. It's the age-old question, isn't it? I've seen investors wait and wait for what they think is the perfect moment to buy, but...
Right? And then they miss out on great opportunities.
Exactly. I had a client who hesitated for months waiting for prices to drop, and by the time they were ready to buy, prices had soared. They lost out on a fantastic property.
So what's the advice here?
Look at the long term. Focus on your investment strategy rather than trying to time the market. Buy properties that fit your investment goals and cash flow needs, regardless of short-term fluctuations.
That makes sense. And if you're stuck waiting for the right moment, you could just be missing good chances.
Right, and always be ready to pivot. If a property isn't working out, don't be afraid to reassess and move on.
And I think it's also about learning from past mistakes, right?
Absolutely. Every setback can teach you something valuable. Just keep your eyes open for red flags.
Like what?
Well, if a deal seems too good to be true, it probably is. Watch out for properties that have been on the market for a long time, or ones that have multiple price reductions.
Yeah, those are signs that something might be off.
Right. And always get a professional inspection. You don't want to be blindsided by major issues after closing.
That's so true. It's all about being proactive rather than reactive, huh?
Exactly. And it's essential to keep educating yourself. Read books, attend seminars, or join a local real estate group.
Good advice. It really helps to connect with others who are in the same boat.
Definitely. And remember, the more you learn, the better equipped you'll be to make sound decisions.
So to wrap this up, it's all about being cautious, doing your research, and staying informed to avoid these common pitfalls.
Yes, and if you do encounter any challenges, just keep a level head. There's always a way to recover or adjust your strategy.
Exactly. It's part of the journey. You learn, you adapt, and you keep moving forward.
Couldn't have said it better myself.
All right, let's transition into what's next.
So you're probably wondering, what can you actually do today to start building that passive income through rentals, right?
Exactly. It feels overwhelming sometimes, but there are definitely practical steps you can take, even if you're just starting out.
Yeah, for sure. One of the first things I'd recommend is to get familiar with some key tools. Apps and websites that can really help you in your journey.
Right. Something like Zillow is a great starting point. It gives you a ton of information about property values, rental prices, and even neighborhood trends.
Absolutely. And if you want to dive deeper into the numbers, check out the Bigger Pockets calculator. It's super user-friendly and helps you analyze potential deals.
Oh, I love that one. It really simplifies the process of understanding cash flow, cap rates, and all those important metrics people often get lost in.
Yeah, and then there's Deal Check, which is another solid option for evaluating rental properties. It allows you to compare multiple properties side by side, which is really handy when you're in the decision-making phase.
And let's not forget Rentometer. It's fantastic for checking rental prices in specific areas, so you can make sure you're setting competitive rates for your future rentals.
Exactly. Getting that local market knowledge is key, and those tools can give you a leg up.
So once you've got those tools under your belt, what's next?
Well, I suggest starting small, like really small. Maybe set a goal to analyze just one deal each week. It doesn't have to be complicated. Just look at a property and see if it meets your investment criteria.
That's such a manageable way to ease into it, and it helps build your confidence over time.
For sure. And while you're at it, joining a local real estate meetup can be a game changer. You get to connect with other investors, share experiences, and learn from each other.
Oh, that sounds fun. Networking can really open up new opportunities, right?
Definitely. Plus, you can find mentors or even potential partners that might help you on your journey.
And, of course, reading books and listening to podcasts can expose you to different strategies and insights.
Absolutely. Some great books to check out are Rich Dad, Poor Dad by Robert Kiyosaki, which has a really good mindset shift about money and investing.
And the book on rental property investing by Brandon Turner. It's packed with actionable advice for beginners.
Right. And if you prefer podcasts, Bigger Pockets has a fantastic one that covers a wide range of topics. It's like having a conversation with experienced investors.
That's a great resource. So, really, the goal is to keep learning and pushing yourself out of your comfort zone.
Exactly. You don't have to go all in right away. Just take small steps. Maybe even try to visualize your goals.
Yeah, having a clear vision can be super motivating. What if you set aside a little time each week just to reflect on your progress and adjust your goals?
That's a smart idea. It keeps you engaged and helps you see the bigger picture.
And remember, it's okay to start where you are. Even if you feel like you don't know much yet. Everyone starts somewhere.
Right. Just take those first steps, keep that momentum going, and don't hesitate to reach out for help or advice along the way.
So, with all these tools and strategies at your disposal, you're well on your way to building that passive income through rentals.
Yeah, there's no time like the present to start making those moves. Now let's bring this all together. Well, as we wrap up today's conversation on building passive income through rentals, I think we really covered some crucial points.
Absolutely. So let's recap some of those key takeaways. First up, the importance of doing your research, right? Knowing your market can really make or break your investment.
Exactly. And then there's the significance of cash flow. It's not just about buying properties, but ensuring they generate ongoing income that supports your financial goals.
Yes, and let's not forget about the power of leveraging your investments. Using other people's money can really accelerate your growth in this space.
Right, and that leads us to the importance of having a solid plan. You want to have clear strategies in place, whether it's about managing properties or reinvesting profits.
And, of course, the mindset. Building wealth through real estate is a journey, and it's important to stay positive and resilient throughout it.
Definitely. Remember, it's not just about the immediate gains, but the long-term wealth you're creating for yourself and your family.
Exactly. So if you found value in today's episode, we'd love for you to like, subscribe, and maybe even drop a comment about your biggest takeaway or a question you might have.
And don't forget to share this with someone over 40 who's looking to invest in property. It's all about building a supportive community.
For sure. And just a little teaser for our next episode, we're going to dive into scaling from 1 to 10 properties fast.
That's going to be an exciting conversation.
We can't wait to share more insights and tips with you.
Until then, take those steps towards your property wealth journey.
Thanks for joining us today, everyone.
We'll catch you next time.